We've paid a lot of attention to what's going on with banks, particularly regional banks, what's happened here. What are the obvious effects, and what are maybe some of the more subtle ones we may be missing?
Well, great question. An obvious effect is you're seeing deposits move from smaller and regional banks into money center banks. You're seeing a lot of questioning of the financial health of many regional banks and a lot of concerns about where the line is drawn in deposit insurance. We're sort of at the worst spot now where we don't know, will it be expanded a lot? Is it going back to where it was? But to me, there's some less obvious but bigger issues having to do with a credit crunch. A lot of commercial real estate lending, a lot of commercial and industrial loans, certainly in the heartland of the country, are made by small and regional banks. And so even if depositors are safe, the credit crunch may provide quite an impact on the economy and on the Fed's job.
What could the possible effects be on the real economy, if I can call it that? I mean, we all care about banks, regional banks. We don't want to wish them ill. But could there be broader ramifications for the economy overall?
Well, of course, if banks are tightening lending because they really don't see good things to which to lend, that's certainly fine. But if banks are very worried now about the loss of deposits, no one wants to be the next Silicon Valley Bank, or fears of needing more capital, and then constrict loans and real estate projects can't happen, small and mid-sized businesses can't get loans, that becomes a quite large effect on the economy. From the Fed's perspective, that's like thinking there's some extra rate hikes happening in addition to the ones that the Fed is doing. And so the credit crunch may well crimp activity going forward, although it will help the Fed bring down inflation.
So let's go back to your question about deposit insurance and where we are on that, because we have some people like Bob Diamond, for example, formerly of Barclays, saying we should at least insure up to $1 million of deposits, maybe have unlimited. If you were back in your old job advising the President of the United States, what's the right answer for the banking system and therefore for the economy overall? What would you advise him? What do we really need from our banks?
I would say let's start with what can't be right. The current law wasn't right. The limit was too small to deal with the modern economy, and the Treasury or the Fed would try to move to increase it whenever we get into trouble. So that's not good. Unlimited, I don't think, is a very good idea. That takes away any incentive for depositors, even a very large size, to monitor the bank. And where to draw the line is hard, because what you would want in principle is the payrolls of small and mid-sized businesses, individuals' transactions accounts to be okay, but those could be large numbers. Here's the concern. The higher we take that limit, the more we push for more regulation of banks. It's not going to be the case that the taxpayers insure all deposits in the country without changing what banks do. And going to our earlier conversation just a moment ago, banks are very important in lending in some activities. So I think we need a more fundamental conversation about what do we want banks to do and how are small and mid-sized businesses and real estate going to get credit.
So, Glenn, one of the things that maybe goes unsaid largely is sort of a desire to preserve regional and specialist banks across the country. We have something like 4,500, I think, right now, banks across the country. Is that too many? Can I ask that blunt question?
Well, I think we've always had too many banks in the United States, certainly relative to any of our peers. That said, while I don't know that we have a policy objective of preserving particular community or regional banks, we do want to preserve the lending activities there. So I don't think it's the case that if all deposits in the United States suddenly moved to the four largest banks, that we'd have the same mix of lending. That's what I meant by we really need to step back, we thinking of the Fed or even the Congress, as to what we want banks to do. But we're on an unhealthy path now of playing with deposit insurance without thinking about the future.
Let's talk about some of the things that could really affect banks and the economy more generally, and that is the debt ceiling. A lot of talk about that now. We're going to have the Speaker of the House come to the New York Stock Exchange next week to address the question as part of a discussion of the overall economy. Where are we in the debt ceiling, and where are we in this discussion back and forth between raising the debt ceiling and curtailing spending?
Well, it's a great question. I mean, certainly we shouldn't default on the debt. So no conversation should end there or even get close to there. But the debt ceiling discussion is a source of rare leverage in Washington to at least talk about spending. The administration and the Congress do both need to put their cards on the table, both about near-term spending, like getting unspent COVID funds back or addressing the growth in discretionary fiscal policy in recent years, and have a serious conversation about long-term spending. If it takes the debt ceiling to have it, so be it.
It also strikes me, but you've spent more time in Washington than I have, Glenn. It takes some political courage to talk about cutting spending. It's fine in the abstract to say we got to curtail spending, but when you get down to brass tacks and say we're going to cut that program, somebody's ox is being gored. Who has the political courage to do that, Democrats or Republicans?
Well, neither, apparently, but I do think there's a different way to frame it. One is to say, look, unspent COVID funds, they need to go back to the Treasury. We've had a big growth in spending in the past several years. Do we really believe that's necessary going forward? That should be not a lot of courage to say those things. As to the bigger problems in Social Security and Medicare, I think the real issue is being honest that we want to preserve these programs. And to preserve these programs, we have to address their structure. That probably starts with a commission or some sort of discussion going forward, but it shouldn't take that much courage to at least get that on the table in this budget negotiation.
That would be nice if it doesn't take much courage. How much time does it take? Because we have these trust funds that I think are running out, are they not?
They are. The Medicare Trust Fund will be out in just a few years, Social Security by about 2033. Economists would say that doesn't really matter. These programs are in bad shape yesterday, today, tomorrow. But it may be an action-forcing event in Washington. We shouldn't wait that long. The longer we wait for either Medicare or Social Security, the harder the solution is on benefits and taxes. There's no time like the present, but I'm not sensing a lot of support for that idea in Washington.
Well, is the idea fleshed out? Is there a think tank, or is there part of some party or some leadership in Washington who are coming up with plans that you're looking at and say, you know what, that's a smart way to do it?
Well, both parties have over the years. If you turn back the clock to the previous budget brouhahas in the early 2010s, the debt ceiling battle, there was also a Bowles-Simpson commission that had interesting ideas from both political parties. Over time, people have had this discussion. We need to have it again, and we need to have it now.
Yeah, Bowles-Simpson. Whatever happened to that commission? What happened to that report? I don't remember anything happening other than it getting published.
Absolutely nothing happened. But I think here we've got the action forcing events of the trust fund issues and the public knowing that something is wrong, that spending has accelerated a lot during the pandemic with no break.